this podcast is geared towards alternative investments.
Mm-hmm.
Was there a shift in time period that you noticed in your, tenure working in this space of when people really started to become more interested in the alternative investment classes?
Well, there was big interest in the venture capital space in the late
Yes.
90s,
Yeah.
right? That was, the tech bubble kind of blew
Yeah.
that up.
Exactly.
And then, when people's portfolios started blowing up, people said, well, we need to figure a way to hedge risk out. So then hedge funds became the next big thing, right? I started to hear about the hedge fund business in kind of the late 90s. Again, remember, I've been sitting in the deepest, darkest back office of Morgan Stanley. So stuff kind of filtered down to me. It eventually got to me. But yes, that's when I started to really start hearing about hedge funds. And I also started hearing about private equity at that time. My wife was working in the equity division, and she worked with some people who were invested in Prince's Gate, which was a Morgan Stanley private equity vehicle back in the 90s. Had phenomenal returns, by the way. And I went to an annual meeting dinner with them, and I was like, wow, this is fascinating stuff. This is really interesting. There's a whole other world out there.
Yeah.
But I was more traditional. It's the stuff that I knew. I really thought at one time I thought I was going to be a trader, and then I turned out, traditional asset management was where I went next. At UBS, we had a product called the multi-asset portfolio. It's a very cleverly named product. I know, right?
Hey, you know what? Simple is good.
Yeah,
Simple is good.
It
Direct
works,
straight
right?
to the point.
Yeah, exactly. And so that one was a combination of our kind of global securities portfolio, which was like the big traditional balanced long only mandate that we had a ton of money in, and you combine that with some private equity and some real estate. So that was my first real, in an investment setting, my first real exposure to these things. Okay. And, again, there was a small piece of the business, and so I didn't get a lot of exposure to it, but I started to learn about, drawdown funds and the liquidity problems that happen when, they're calling for capital and you don't have it, and so on and so forth. Right. And, how do you deal with the fact that these things are valued quarterly and you get the valuations on a lag and all that sort of stuff. Right. And so that was my first real exposure to that.
Very cool.
Yeah.
If you can think back to that time, maybe what kind of excited you the most during that time period about maybe venture capital, hedge funds, land, real estate, those types of alternative investment classes?
Well, I always thought of real estate as kind of a blend between equity and bonds in a way, right?
Absolutely.
That's definitely a good way to think about it. The sort of real estate we were doing was very, core real estate, which would definitely fall into that space, right? If I think about real estate that we did at, say, University of Chicago, that was all opportunistic value add, more, more juice, more octane, more risk. Just the idea that you could, what's the one big bet you're always making? You're always making this kind of stock versus bond bet, right? In pretty much any multi-asset portfolio, if you're an RIA, if you're managing money for an individual, you're making that's the big thing you're making. How much risk are you taking? And the way you're doing it is you're doing it stocks versus bonds. But this was a chance to get some sort of different risk. You know what I mean? And as it turns out, a lot of it is pretty highly correlated.
Yeah.
So it turns out to be less of that than I thought. But at the time, that's what I was thinking is, oh, this is a way to diversify your risk away. And it's like, well, you can't really. It's just really different ways of repackaging risk, right? And so once you get that insight, then it becomes more. Okay, well, how can I most efficiently get the risk profile that I want?
Yeah.
Right? And so then you have these tools to do that.
Yeah, matching those duration of cash flows and things like that, which obviously alternative investments vary when we look at land. You're looking at the longer term versus, maybe private equity or venture capital, maybe a little bit on the shorter term. Let's talk. So you worked through the 2008 great financial crisis. And, as someone who was a little bit younger, and I remember that time, but did not work through it. Talk to me about how maybe the mindset or the mood changed towards alternative investments during that time, during and after that time period.
Well, remember, I was working at a traditional asset manager at the time, right? And most of what we were doing was, trying to decide when we wanted to put on more risk or whether we should even cut it further. And there was definite lots of disagreement in opinions among the senior decision makers, which you would expect in a volatile environment like that when, you think you know what's going on, but you really don't. There was definitely an allure to being able to take more targeted risks and to separate, say, market risk and security selection risk, for example. We had products at UBS that did that, and they were really popular leading into the global financial crisis because there were things you could do, like you could buy, a small cap manager, and then you hedge out small cap risk by using Russell 2000 futures. And you buy S&P futures, and all of a sudden,
Mhm.
boom, I've got broad market
Right.
risk, but
Yeah.
I've got small cap security selection, and that's beautiful. And then
Mhm.
you started to think, can I do that on a broader basis across the portfolio? And that's akin to a hedge fund in a
Yeah.
way, right? There's hedge funds that do things like that. There's
Mhm.
others that do, the, the words hedge fund always kind of have bothered me for years because it's such a broad
It's such a broad term for like
thing,
all
right?
of the, and there's so many different types, and
Exactly.
it's all really, they're all funds,
Hmm.
but they're all specializing in their own unique thing, and they're all, the structure of how things, our fees are structured is all different.